Good evening, everyone, and thanks a lot for joining this webinar. Delighted to get this opportunity to share our thoughts on our latest newsletter. I'll just quickly start off with a quick update on our, key strategies that we have. And so for Ambit Coffee Can, this month we ended with roughly around zero point 0.8, around 1% alpha. Um, so the key performers for us were Avenue, ZF, and KFin, whereas some of the laggards were Zomato, which was down 10%, and Bajaj Auto and Abbott. Uh, and the important thing here to note is that when you look at this performance for this fund, now it's almost finishing close to around 9 years. And out of those 9 years, if you look at the first 4 5 years, we typically had alpha anywhere between 6 10% if you look at the first ones. And in then we had these two difficult years, which is calendar year 22 23. In our newsletters, we have gone in detail explaining why this was so, because of the kind of stocks like more on the deep cyclicals, many of the PSU-led rally. And since then, CY24 was the year where it reversed. And I think the overall trend, the style preference is coming back. So we are positive on the same. Next. Yes. So when you look at Ambit Good and Clean, our the key performance during this month was PI, Blue Star, Emphasis, and some of the laggards were KEI, AU, and IGI. On a 1 year basis, if you notice, this fund still has roughly around 5% alpha. Overall 1 year return March end was close to around 11%. Next one. Emerging giants, some of the stocks which did very well was Prudent Corporate, where it was up 40%, MPS, Karware Technical, whereas, Green Panel, Rajratan, and Moltex were on the downside. This month, their performance was -2. Next. Same for Ambit 10x. When you look at some of the top performers, there was again Prudent, Garwar, Technical, and PI, which did very well. On the bottom performers, you had Orchid, Metro, and Venice. The performance here was more roughly around 3% on a 1 month basis. Next. This is our, the new fund which is there, and here again, some of the stocks did very well, which is Ice Make up 40%, MPS, and Shraddha Crop Care, whereas the laggards were Landmark Cars, Rajratan, and Entero Healthcare, which was down 10%. Right. So with that, I'll now move on to our newsletter that we had. So if you look at this. We have kind of, if you look at the newsletter, we've called it Understanding Risk. Essentially, the idea was to talk about, the environment we are in. And in this newsletter, we have kind of, not only is it talking about risk, it talks about, how we think about investing, our philosophy. And we've also tried to, merge it with our thoughts on the market currently. So, if you look at the two characters, the Chinese character which are there, essentially that's the word for risk in China, in Chinese language. And each word has a meaning. Like the first word means danger, the other word means opportunity. So, in Western finance, often people use it to kind of, convey the sense that, every risk has both a danger part and an opportunity part. So, if you move to the next one, start. So I think the key point, what we tried to do in this Understanding Risk newsletter that we wrote, we took our key learnings from, all of you would have read this classic book by Howard Marks, which is called The Most Important Thing Illuminated. And, it has a lot of, summary or learnings from him, as well as, Talib's book of Black Swan. So the most important thing that I think in a portfolio investing that I got really influenced by after reading Howard Marks was his thoughts on how to think about risk. So he starts off by talking about how whenever someone approaches him on markets, he asks him the question that what is it that matters most to you? Is it return maximization, or is it not losing money? And he says that invariably people come up with the answer that they want both, that they want to maximize their return and at the same time not lose money. To which the whole book then he talks about how both these things are not possible. So he says that if you're taking higher risks, then the probability of losses also increase. So at some point every investor in this spectrum of risk aversion that we see in the exhibit below, they have to figure out as to where they want to kind of lie in this entire spectrum. So if you look at the extreme left, that would be what you would call as risk off. The risk aversion is very high, something like treasury bonds, and it would be a very very defensive, the extreme of defensiveness. Whereas, if you look at the right, it is the extreme positive of offensive, where, the most aggressive form of investing is venture capital. And this is a segment which is, where you are completely risk on. So the characteristics of a market when it is in a very low risk aversion is there's a lot of greed, there's optimism, there's overconfidence, there's credulity, in a way daringness, and the risk tolerance is typically very high along with very high aggression. Whereas if you were to go on an extreme left, then there's complete fear, there's pessimism, there's skepticism to any good news, there's caution, there's risk aversion, and generally there's a reticence to any positive flow. So what he's trying to what if you think of risk is that market in a way is like a pendulum which moves towards both left and right. You have periods where the risk aversion is very low, and then because of the excesses that happen, you move to a period where risk aversion becomes very high, and the overall defensiveness increases. So as we speak, we are just coming out of a bull phase, which lasted from post-COVID FY21 to, I would believe, more like September 24. And since then, markets been in a correction mode, which kind of got accentuated in January. And, since then, the volatility has been high. To just give you a sense, from post-COVID till September, on a monthly level, the volatility on the market was extremely low, with none of the months having more than a 5% decline. This, when you look at in a historical context, is very low volatility, because typically the volatility is very high. The most important thing for any investor is to have a right balance between both trying to maximize their return and also be defensive. So that's why there's this very famous saying which is there in the slide here, which says that the most famous saying sums it up, which says that there are old investors and then there are bold investors, but there are no old and bold investors. The summary of the same is that one needs to be both offensive and defensive. And our belief is the current market, is something where defensiveness has to be on the higher side. Next slide, please. So we just start off by saying that, when you're looking at assessing investment performance, what is it that, one should focus on? Like a lot of people in the last 3-4 years, when you look at, how funds were being sold, it was being sold on a 1 year, 3 year performance. And often, not too much diligence was happening beyond the immediate performance. So there's this famous saying by Warren Buffett again, which says that it's only when the tide goes out that one finds who's been swimming naked. And in this book, they prescribe these 4 things which you should ask for any particular performance to in an effort to understand the performance of any portfolio. The first being, how much risk did the manager bear to get his return? Was it a fair weather portfolio? Was the portfolio tested for red flags and sharp practices? And lastly, how would it have held up if the environment had turned hostile? So the last question means more like what we are seeing currently. Every now and then there is a black swan event or something that we had never thought of. And the very nature of this black swan, the word itself implies that it's not something you can when it will come or predict. And as such, for a prudent portfolio, you have to be ready for such event at all times, because you know that such a thing can hit you anytime. Next slide. The book summarizes what is risk in a very crisp manner. One can divide risk in three buckets. The first one is being the absolute, which everyone knows that the key risk in the market is to lose your capital. So this would happen if you buy some low quality company, or if you indulge in leverage trades, or any such aggressive thing where you have to cut your losses. So those are where you lose absolute return. The second one is the probability of missing out, or what you can say is relative, where often there are a lot of opportunities in the markets, and every opportunity which is foregone represents a serious performance shortcoming. Like if you look at the period between 21 24, there were other than some the so-called non-quality, there were other companies also which went up. So all those misses are also a shortcoming in the same way. The third one is what is the behavioral side, which is the risk is the likelihood of being forced out at the bottom. So here, the author talks about how many investors claim to be long-term investors, and thus they feel they are immune to fluctuations. But bad enough declines that when markets actually fall, or when stocks fall, just the nature of that fall, or seeing a stock fall, can make many people nervous, can make them lose their confidence, because they receive margin calls. Or it could also be that at sometimes you need real cash, you need cash, and hence you have to sell. So these are behavioral aspect which can lead to capital loss. If you look at some of the greatest pain in 2008 was felt by investors who overestimated their ability to withstand volatility. So typically in a market, whenever there is a black swan or there's a major bear market, markets often, correct very sharply, and often by as much as 30-40%. And it's only, in that environment, will you know who has the stomach to see that kind of a fall, because till then it's a theoretical construct, and it's a theoretical question that will you be able to see fluctuations. And often the behavioral side of the market is what plays out in a bear market. So it's not that everything which falls is a bad company, or everything which is falling is a risk, because a lot of it could just be fluctuations. As we know that often when market falls, almost any and everything falls. Like if we were to look at day before yesterday, when market was down 4-5%, almost any ticker was down 4-5, irrespective of whether it was a quality company, good company, and so on. Next one. So, how should one then think about risk? So, we start with this. So, one of the biggest mistakes that most investors do, and is also a result of, how many of these funds are sold, is a belief that there's a linear relationship between risk and return. So, a lot of people, give a sense that, if you want to earn high, you have to take higher risk. So if you see this line, more risk is not equal to higher returns, and it's been cancelled by a red line. So what he tries in detail to explain is that this very concept is wrong, and his logic is that if by taking higher risk one could earn higher returns in a predictable way, then the risk would not be high in the first place. So the only reason why people say it's high risk is that the probability of actually that happening is very low. So his thesis is that people sell these kind of products where theoretically they show very high returns, is that there is a perception that you can only sell them by showing a very high risk, and that is just for something which is shown, but in the possibility of that projected returns to get delivered is very low, and that is the key risk. So, the thinking of more risk equal to higher returns is something, we should do away with. It's essentially this market is about, the lesser the risk you take, and the how you can, conserve your capital is how you, in the long run, increase your returns. Yes, next one. So instead of that, instead of the exhibit we just saw, the author says we should think about risk and return in the following way. So he says essentially, like if you were to use a Peter Bernstein's, definition of what is risk, he talks about how essentially risk says that we do not know what is going to happen. We walk every moment into the unknown. There is a range of outcomes that a lot of things can happen, and we do not know where the actual outcome is going to fall, and sometimes we don't even know the range. Like sometimes we say market could fall by 5 to 10% or 5 to 5. Sometimes we don't even know the range, and it's very difficult to say where within that it will fall. So the higher the risk you take, this range increases, and your probability of actually ending up with losses increase. So I think this is how one should think of risk and return. And he talks about it in a way that when I started off the entire thing by talking about how investor has to decide in the spectrum on between the risk maximization and capital protection as to where one stands. I think it all depends on what is that you're looking for. If an investor is looking at like a 5-10 year, looking at longevity, looking at how do I maximize my return in the very long term, then he's essentially looking for the magic of compounding. And the moment you're thinking 5 year, 10 year, the first thing which you think of is how do I survive for 5 years, 10 year, 20 years. So you essentially become more conservative, you become more defensive. Whereas, if your objective is to, get a glory, like say a shooting star, that is, in 1-2 year, suddenly, multiply your money by 2-3x or become like rich overnight, then obviously the risk that you take has to be, your risk tolerance has to be very, very high, and you have to be like at the extreme end of offensive or the aggressive style of investing. Next one. And why is it important to be wary of black swan? This is, a parable by Taleb, which explains it very well. So, here he talks about, gives a parable of a turkey. He says that, let's assume that you're in a turkey, and when you were born, you were given this thing that, you look at the history as to what's happening and plot as to what would be the experience of your entire flock. So on the left hand side, if you see, it's the axis says humans are suspect. All right, great. These are the emotions of a turkey. So when they are, when they initially start, they have suspect for humans. But then, the humans feed them every day, give them a lot of space to move around, and they have a very comfortable life month after month. And so, their expectations move from suspect to all right to great. And just when they believe that, humans are great and everything is hunky dory, is the Thanksgiving day, and they get turned into the dinner for that day. So what we essentially tries to say is that there's certain risk, like if you are in a environment where there's a sudden risk, and if you are in a lot of these companies where there's promoter issues, or there is deep cyclical thing, the risk plays out in a black swan manner. Whereas, just the fact that for last 3 years it did very well, or the fact that, things have been going great for several quarters, it just needs a very quick this thing for it to play out. And essentially the result of that is very, very bad. The reason we are talking about it is because, in any bear market, towards the end, there are many, many companies which go through this. Like if we start at, say, 2000 bear market, the top performers of that market, whether it be Himachal Futuristic, Global Tele, you name it, I don't want to name them, But they all saw exactly what we are seeing here. Then if you go to 2007-8, the same thing happened where companies lost as much as 80-90%. So this time also, in a correction, those kind of companies will have a similar fate and so on. So that's the broad thought process behind this. Next one. Next slide, please. Yeah. So, this is a very quick one where he kind of summarizes as to what we can learn from past crisis. And, he starts off by saying that the most dangerous investment condition, which generally stems from psychology that is too positive. For this reason, whenever market is in such a situation, fundamentals do not have to deteriorate for losses to occur. Downgrading of investor opinion will suffice. High prices often collapse of their own weight. So what the author here says is that the bear market typically always comes after a period where people believe nothing can go wrong, where the bullishness is at its height, and where risk taking is rampant, which is I think what we saw for most of the 23 and say the first 4 5 months of 24 itself, before things started turning a bit negative from say maybe September October. And the learnings for him from past crisis is that when you have too much capital availability, then money flows to wrong places. And when capital goes where it should not, bad things happen. When capital is in oversupply, investors compete for deals by accepting low returns and slender margin of error. This is what we saw in the IPOs and so on, where companies got sold at prices from where it was almost impossible to make money and so on. There's a widespread disregard for risk, which in a way creates greater risk. Inadequate due diligence leads to investment losses because money making becomes so easy that due diligence takes a backseat, and many people don't spend enough time on that. In heady times, capital is devoted to innovative investment, many of which fail the test of time. Hidden fault lines running through portfolio can make the prices of seemingly unrelated assets more in tandem. Psychological and technical factors may swamp fundamentals. So while you may say earnings growth is this, fundamentals are this, but in a bear market, the psychology, technical factors that can play a bigger role. Markets change, and many of the models which may have worked in the very recent times stop working. And in this, if you have leverage, then it magnifies all the negatives. So this we all know is the most negative. And lastly, excesses self-correct. So if we have seen a period where excesses have happened, it has to self-correct by itself. Like, anything that we put it that it happened because of this is just a excuse we give, but excesses have to self-correct. Next. So, on this, what are our philosophy? What are the things that we have taken away from, on the risk management side? So, if you look at Ambit, we believe that, our first focus is on capital protection. Our attempt is to first understand the downside risk. Then we try and understand what could be the upside. We are willing to forego potential returns in poor governance stock, deep cyclical, fat stocks to limit our downside. We stay away from venture capital style of investing, avoiding leverage plays. And lastly, we believe that selling at the bottom, turning a downward fluctuation into a permanent loss, and missing out on subsequent rebound is the cardinal sin in investing. While constructing our portfolios, we believe in being slightly defensive as we need to be prepared for any black swan event. And lastly, one needs to be always prepared for a black swan because these are things that you cannot predict. The table below kind of just gives a breakup as to for all the different funds we have, where is the breakup and where in this spectrum of from deep value to high growth and hyper growth, where do we lie? Next one. So from here, let's get more into the markets. And, what we have done is we've written three key risks that we see, and we have talked about two opportunities that we are seeing. So amongst the three key risks is that valuation still continues to be expensive, more so for the broader market. So large cap is something where, valuations still seem fair today. But, when you look at the broader market, despite this correction, valuation seemed high. Uh, the second would be that the recent rally was driven more by weaker companies or more deep cyclical companies and so on, which we'll come to in the next slide. And the corrections here could be sharper. And lastly, the liquidity risk remains very high, and we believe it's still not much appreciated. Next one. So, this is a proprietary data that our institutional research at Ambit Research Capital, they do. What they do is they divide a company in 10 decile 1 to 10, based on the quality of the account, quality of the management, and so on. And what they do is they call the zone 1 to 5 as the zone of safety. And as the quality of those accounts or quality of those companies fall, the zone 7 to 10, they call the zone of darkness. So what they have typically found is that, companies lying there is where you have the maximum accidents. These are the companies which, give you most losses and so on. So this chart is nothing but, returns got from companies in zone of safety minus the returns got from companies on zone of darkness. So what we see is that, say, if you look at the period from 2013 to 17, basically companies which had better which were more in the zone of safety, which had better accounting practices, which were better quality, did much better than the weaker companies. But whenever the markets reach excesses, as it did in 2017, you will see that the weaker companies or the more companies in the zone of darkness, they do better. And again, in between 2022 to 23 and to some level of 24, we saw the same thing happening. So we are just coming out of a period where companies with low quality, companies with suspect accountings and so on, they have done significantly better. And typically this then is as and when these things come out, typically then you see a period where there's a sharp move towards quality of safety. Next one. We have all this in more detail in the newsletter. I have just taken, small for this PPT. So liquidity risk remains another very key risk. So if you look at the first, exhibit, which is in red, which is the top and the below one. So if you look at the number of companies in India which have a market cap of more than 5 billion, we are next only to Japan. Japan is some 204. We are at 198. Whereas obviously US is close to 1,000, China is 386. But if you look at the chart below, which is the number of companies with an average daily volume of say more than $5 million, then India is at 444. So if you look at the multiple, while we have 198, so 198 divided by this is more like 2x. Whereas for all other, it is a much higher multiple. So the liquidity as such is low. Even when you look at the cash volumes and the future volumes, since peaking somewhere in June, July, they've all been declining. This is data as of March. And so, liquidity is an issue. Next one. Also, what they have done is, this is a data where they've compiled as to the free float of how much is available in large caps, mid cap, and small cap versus the supply, which versus the demand that we get. That is, new inflows from mutual fund or the new buyers and so on. So if you look between June 17 to as we stand today, the availability factor for Indian equities, despite all the record IPOs and everything, has been falling. And as this number falls, automatically, think of it as a demand and supply. As this supply is falling, as this number is becoming lesser, the valuations tend to be on the higher side because, you don't have enough companies to invest the money that you are getting. So this is another issue in terms of when you talk of liquidity. The one below is nothing but, what it measures is the top 4, 5 funds in both mid cap and small cap. So what you notice is that, the performance for all these peaked sometime between, say, June and September. So what happens is as you move ahead, like we already in April now, as we move ahead over the next 2, 3 months, the highs of, June, September, they will become your base. And, if I were to extrapolate these numbers, assuming market remains same, or even if I assume a 5-10% increase in market from the levels in 10, from the levels in Jan, what will happen is that the returns for many of them will start looking muted and may even appear negative. So how will investors react to this, who have been used to, if you see the period between say 22, 23 to 24 of very high returns, how they will react to this environment is something which will be tested, and I think is a key risk in the market, because as you all know, 60-70% of the new demat openings which have happened, or the large number of new investors who have come in the last 4 years, their behavioral aspect has not yet been tested, and something like this will really test their behavioral aspect. Next one. So now coming to where do we see opportunity? So the opportunity we see is, if this exhibit, we have two things: the red line, which is, so if you look at the orange line, which is dotted, this is falling concentration, and the red line is rising concentration. This is nothing but, what they have done is they've taken the Nifty 500 stocks, their weights, and, they have done a square root of the same. So essentially, what it means is that, just the way you create an HHI index, which is for competition, they have done the same here. And what we notice is that whenever market becomes broad-based, that is, even small caps, everything is doing well. The large caps do give lesser returns, and the mid and small do better. So if you look at the immediate preceding two periods, the period between 18 to 21 was a period where concentration was high. Only, select companies, or, the large companies were doing well. So during this time, the large cap return was positive on a CAGR basis, 2%, but the mid and small were negative 8 and 15% on a CAGR basis. What we saw after that was, for a period of 3 years, we saw market becoming very, very broad based. And in this time, the large caps did not do that well, versus say a mid cap and small cap, which almost went up like 37-35% CAGR. We think this trend is now shifting towards large cap. So we think large caps is a segment where there is good opportunities, large cap and the quality companies. Next. Also, this is now getting reflected in numbers as well. So if you look at the Nifty incremental PAT contribution as a percentage of total, then if you look at the top five contribution was 85% in March 24. In September, it became 120%. In December, it's 106%. So, this has been increasing. Also, if you look at the provisional retail flows, as of March, after a long period of being very high and positive, it looks like it turned negative in the month of March. So these are some of the risks that we see in the market. Next. Lastly, the key on the opportunity side is that, India, because of its favorable demography, because of the structural long term opportunities you have, it being a democracy, being having the per capita income increasing, disposable income increasing, there are many sectors which will see very, very strong growth as the disposable income or the discretionary spends increase. And so while what we talked about may be very macro, or some of these concerns may be global in nature, we will find many opportunities on a stock specific basis. So at Ambit, our focus is more to be very bottoms up, and our portfolios are more like 18-20. So what we have to do is find 18-20 companies where we can find some of these ideas and invest there. Yes, next. So now, just to quickly summarize, we all know there are three kind of risk: the absolute, relative. Right now, what we are being tested for is more the behavioral side. For companies, for all the investors who have faith in the stocks, who know what they are holding, they will find it relatively easy to sit through the high volatility if they know they are holding quality companies, good management. Whereas, for a lot of the investors who don't have that kind of confidence in their portfolio and all, you will see that the fluctuations will unnerve them, and you could have negative developments, negative kind of outcomes there. The next is that, as per him, the road to long term success runs more through risk control than through aggressiveness. So he says that our entire career, most investor results will be determined more by how many losses you make rather and how bad they were rather than the greatness of their winners. So, investing is not venture capital. This thing, there's a strict differentiation. In a venture capital, you will have money for 8, 10 years, and you only have to give back money after 8, 10 years, which is not the case in investing. And we have limited capital. So, the thing of buying 10 companies and hoping two, three will do so well over 10 years, 20 years that it will make up for the others which didn't do well is not something which works in, the equity investing as such. Here, what works is to limit your, downside. That's why the Warren Buffett line that, the rule number one is never lose capital. And the rule number two is never to forget the rule number one. Investing consists of precisely one thing, which is dealing with future. And because we do not know the future, the risk is inescapable. So the main thing in investing is how do you manage risk? And as I was mentioning, what positioning an investor chooses in the risk tolerance spectrum will depend on what you are aiming for. If you're aiming for longevity, if you're aiming to create wealth over 5, 10 years, then your focus will be on magic of compounding. You will lean more towards defensiveness and conservativeness. Similarly, if your aim is for rapid speed, like glory, like a shooting star or becoming a star overnight, then you will have to then lean more towards have very high risk tolerance and lean more towards high aggressive investing style. Historically, if you see, most of the accidents in the finance history has come in the second bucket. I think while we don't have many examples because organized investing, where the mutual fund and all don't have that bigger data, history in India. But a good example would be if you look at the private lending, private banks. So, if you think of one or two very conservative banks, say like something like a Kotak or something like an HDFC bank, look at the wealth they have created. And then, look at many, which were there with them at the same time when they started and or came after, and look at what's the fate for many of those banks or what happened there. The difference, if you see, is just this that, they wanted speed, they wanted to grow very, very fast, very quickly. That was the key difference versus the top two three banks and then the fourth fifth and the long list of other banks. We believe that Indian markets today stand at an inflection point, and the reversal of market anomaly over 21-24 is now in motion. So we think there's likely to be a sharper shift towards quality and large cap. And one of our funds which we discussed, which is Coffee Can, we believe is well poised for that. The key risk remains low liquidity, high concentration, which is where the black swan kind of challenges could emerge. Then Now this data is interesting. It says that in the past two market cycles, if you see between 11 to 13 and 18 to 21, 85% of the Nifty 500 stocks registered less than double-digit returns per annum. So, in this kind of environment, the market becomes very, very polarized. It's only few stocks which do well, and as such, one needs to be cognizant of that in this decline. Increasing polarization provides opportunities for large cap, particularly in the BFSI side, and attract some of the attractive sectors we talked about. Lastly, at Ambit, we prioritize capital protection first, and we first look at downside risk and then avoid investments in poorly governed, cyclical or trend-driven stocks. This summarizes our entire newsletter. And, as the summary kind of talks about that, risk management is the key thing which will decide your long-term returns. And one needs to have a right balance between being aggressive or being offensive and, being defensive, because protecting your capital is the main motto. Lastly, we think there's the shift in the market towards large cap quality is likely to accelerate. With this, if we have time, Sahil, we could quickly ask Trilok to cover his thoughts and then open it for Q&A.
Hi, good evening. Thanks, Siddharth, for the wonderful insights on the risk and what are we thinking about those in the market. I'll quickly, take over what's happening around the world, and essentially, post in the last 3 months, particularly, what the risk has hit us, particularly, in the emerging markets as well as developed markets, is thanks to what US, newly elected president is trying to do. Uh, since the time he obviously assumed office in the United States, the tariff imposition across trading partners were a serious, discussions happening. However, the surprise to most global participants came as either, with respect to the quantum of the tariff that he imposed in the most to the most, trading partners. So essentially, reciprocal tariff is what they have implemented across. And this will be in two parts. Base tariff, which is 10%, essentially coming in most countries from 3rd of April, and subsequently, base plus additional tariff will start from 9th of April. So in India, as we speak, 26% tariff has been imposed for the country. When we compare this compared to any other country, whether it's Southeast Asian partners except for China, we obviously are significantly better advantage compared to anybody else, given the fact that a as a percentage of export we are not very large. More importantly, we obviously have a net import deficit, the United States lower compared to other countries barring China. Now, a quick perspective on the which are the broader sectors, or the whirlwind that we think will have some implications on the markets, and both listed, unlisted, and opportunity in the
I
country.
think the main thing we were trying to say is like couple of sectors, like whether it be pharma, textiles, where this would be relevant for India. But again, when you look at a sector like pharma, we have almost like 35-40% market share on the generic side. So how will this play out if they were not to import from India? What would be the both India, China, they've kind of put these kind of things. So it's very difficult to kind of put up capacities there immediately on that. So those issues will come up. So all these are, a lot of these things are unknown and so on.